I believe you've heard the phrase that whatever goes up must come down, and we have also heard that the market moves in only three ways. It is either on an uptrend, downtrend, or a ranging market. So today we are going to understand market structure. And in simple terms, market structure is simply how the market forms highs and lows over time. When we are looking at a line graph like the one you see on my chart right now, you can see that the market has a defined pattern, which is a very clear downtrend. But when you're looking at candles, the movement is not as clear as it is shown here on the line chart. And that is why I chose to use the line chart for this explanation for us to understand. So if you look on the chart now, it is a clear downtrend. You see, you don't even need to over contemplate on this one. It is clearly a downtrend. And when we get here, you see the market started ranging, which means for us to confirm whether it is continuing with that downtrend that was forming or it is going to the upside, we need to wait for this consolidation to end. And this is what we call the sideways or ranging market. Then the uptrend, let's see the uptrend. And this is an uptrend. You can clearly see that market is continuously forming higher highs and higher lows, higher highs and higher lows. What are higher highs and higher lows? You see the high that forms next is always higher than the previous high. This high is higher than this one. This one here is higher than this one. So that is what we call higher highs. And then what are higher lows? Higher lows are when the next low is higher than the previous low. Yes, there are lows, but this one is higher than this low, and this low is higher than this low. That is what we call higher lows. And then in the downtrend, as we saw before, you can see that the market is forming what we call lower highs and lower lows. Why lower highs? Because the high that is formed next is lower than the previous high. You see this high here? It is higher than this. That means this lower high, both are highs, but this is lower than this one. So lower highs are being formed, lower highs are being formed, and then lower lows because the preceding low is always lower than the previous low. It's always lower than the previous low. So in simple terms, that is the market structure. And then for the consolidating or ranging market, you realize that the market is always forming a mixture of higher highs, higher lows, lower highs, and lower lows. They are mixed. And you can already see that every after consolidation, the market will either go up or down. So that is why it is always advised that we don't trade when the market is consolidating or ranging. I hope this helped you understand market structure better. Happy trading. Don't forget to follow, share, like, and comment.